Let's jump right in. Welcome to this explainer, where today we're unpacking a massive Wall Street debate surrounding one of the most polarizing stocks on the market right now, Sandisk. I mean, this isn't just another tech company anymore. It's become an absolute battleground stock where massive fortunes are currently being made and lost. Today, we're going to look at exactly how one single ticker is generating two completely different stories.
Okay, 500%. Over the last year, Sandisk hasn't just grown, it has been on an absolute tear, surging nearly 500%. To put that into perspective, an investment that historically might take a decade to mature has delivered life-changing returns in just 12 months. This historic rally has set the stage for a massive tug of war among some of the smartest analysts on Wall Street, who frankly cannot agree on what comes next.
So that leads us right to the core question driving our explainer today. Are we witnessing a structural shift, like a permanent, fundamental evolution in how the world buys and consumes memory chips? Or is this incredible run just a classic cyclical trap? You know, a massive boom that's destined to be followed by a painful, inevitable bust. Here's our roadmap for today. We'll start with the Sandisk divide, explore the bull and bear cases, dive into the technicals, reveal a wildcard technology, and finally, wrap up with actionable insights on what to do now. Part 1. The Sandisk divide. Two completely different stories. Moving to Part 2. The bull case. Selling certainty. Let's start on the optimistic side of the aisle. We've got some of the smartest minds in finance looking at the data and arguing that Sandisk is no longer just selling NAND chips. In an AI-hungry world, they're selling long-term certainty through a brand new business model. Look at this. A massive 67% of their 2028 production is already safely locked into contracts. More importantly, these contracts feature what's known as floor pricing. In plain English, even if the bottom totally falls out of the broader memory market and chip prices crash globally, Sandisk's revenue is protected by a mandatory, legally binding minimum price. And we're talking about $94 billion. These long-term agreements aren't small change. They represent a staggering $94 billion in locked-in value. That foundation completely changes the risk profile of the company. It effectively guarantees a massive pipeline of cash for years to come, regardless of any short-term economic hiccups. Honestly, this $94 billion figure is the absolute bedrock of the optimistic bull thesis. Now, check out these margins. In Q4, Sandisk's gross margins hit 84.6%, with long-term targets holding steady at 80%. To understand why this is blowing analysts' minds, you have to remember that in the tech world, hardware margins are notoriously thin, because building physical chips is incredibly expensive. Hitting 80% puts Sandisk firmly into software company territory. It's like they're selling digital subscriptions with almost zero overhead. This is exactly why Wall Street is struggling to value them. They're traditional hardware builders suddenly generating software-level cash flow. It's wild. Let's flip the coin. Part 3, the bear case, the cyclical trap. As objective observers, we have to look closely at the skeptics. They see a dangerous, historical trap just waiting to spring. And the divide on Wall Street right now is literal history in the making. On one side, analysts at Bernstein and Evercore foresee the stock soaring to $3,000. On the exact opposite side, Wells Fargo is waving a red flag, warning of a steep drop to $1,550. The bears have some glaring warnings for anyone buying the hype. First off, history. The memory chip sector has never, ever escaped its boom and bust cycle. Second, those $94 billion contracts, they're completely untested in a down market. If AI demand cools off, customers locked into high Sandisk prices might just revolt. They could break contracts and flee straight into the arms of hungry competitors like Samsung, SK Hynix, and Micron, who are aggressively flooding the market with new chips right now. Then there's the price tag. Right now, Sandisk is trading at 22 times its trailing earnings. So in plain English, investors are paying a massive premium for every single dollar of profit the company makes today. The bears fiercely argue that at this high multiple, the stock is priced for absolute perfection. If there's even a minor speed bump in AI growth or chip demand, that premium valuation vanishes overnight. And if you think a crash can't happen, just look at last quarter. The stock suffered a brutal 43% nosedive from its summer highs of $2,354. This is an ancient history. The bears argue this extreme volatility proves the cycle is alive, well, and incredibly dangerous for anyone assuming the stock will only go up. Part 4, technicals and key levels. Let's see what the chart says. With fundamentals pulling into completely different directions, we have to let the objective technical data act as our referee. Right now, Sandisk is walking a tightrope right around $1,656, which perfectly aligns with its 50-day moving average. Think of this line as a crucial psychological barrier in the sand for short-term momentum. Staying above it shows strength, while dipping below it signals a ton of weakness. But the undisputed heavyweight number to watch this week is $1,733. Following a massive surge in trading volume, the stock has been relentlessly knocking on the door of this exact price pre-market. It is the ultimate testing ground for whether the current rally actually has any legs left.
Here's the battle plan based on those numbers. A high-volume breakout above 1733 gives the bulls complete control, likely triggering a fast, aggressive rally up to retest the $2,000 mark. But if it hits 1733 and gets fiercely rejected, that 50-day moving average turns into a hard ceiling, likely sending the stock tumbling back down to 1,500 for its next leg down.
Part 5. The wild card. HBF technology. The unknown variable.
Beyond the multi-billion-dollar contracts and the daily chart levels sits one massive, speculative variable that could completely blow up both the bull and the bear models: hybrid bonding flush, or HBF. Think of this as a revolutionary rewiring of how memory chips handle massive AI workloads, allowing them to process data much faster while using a fraction of the electricity. Right now, this technology generates zero revenue and has no major design wins. But if Sandisk successfully commercializes HBF and gets traction, it creates an unbreachable technological moat that simply isn't priced into the stock yet, representing massive upside potential.
Finally, Part 6. What to do now. Actionable insights. So bringing all these contrasting viewpoints together, how do you actually make sense of this intense battleground? Well, it really comes down to your personal strategy. If you're an AI believer who thinks we're in a structural transformation, that huge dip from the highs is just a long-term buying opportunity. If you're a cautious momentum trader, sit on your hands and wait for a clean, confirmed breakout above $1,733. And if you're playing defense, let the dust settle and wait for a pullback to the 200-day moving average, near $1,400, to minimize your risk.
I'll leave you with this final thought to ponder. As you watch those key numbers unfold in the market over the coming weeks, when you look at Sandisk today, are you buying the structural AI story, or are you selling the historic hardware cycle? Keep your eyes on the news, and above all, watch that 1733 level. Thanks for joining this explainer, and we'll catch you next time.